Okay, hi everyone. We're gonna get started. This is Andrew. Again, I gave some lectures earlier in the semester on stochastic, optimal, continuous time, continuous state space control. And previously, we had looked at this problem here, where we're trying to do we're trying to control in some optimal manner both a deterministic system, and then we added some stochasticity to that system. Through this equation that we have here, we added some Brownian motion to create a diffusion process. And then the goal was to try to optimally steer that basically towards zero. So we captured that through some terminal cost that was quadratic in our final position x. We also looked at basically the same problem, but with additional obstacles involved, where you suffer some infinite negative penalty when you enter these regions here in white. And we call this the drunken spider problem. And that was the second lecture that we had on this topic. And today, I'd like to present on something I've been kind of studying in my free time. This is not the subject of my primary research, but this is an application to finance, to algorithmic finance. So in particular, we're going to look at the optimal portfolio problem, and hopefully learn just a little bit of an introduction to finance through that. However, of course, you always have to put the disclaimer whenever you talk about finance. This is not financial advice. I don't know what I'm talking about, really. I just understand a little bit of math. For those who are in the room, I'm going to put on my Enron cap so that everyone knows this is not financial advice and you should not trust what I'm saying beyond just the mathematics of it. Yeah, I came prepared. It's my favorite hat. Okay. So we're interested in optimal control in finance, and in order to start talking about finance, we need to first talk about a model, right? That is the basics of control. And when you approach a control problem, you always start by first defining a model, and once you're doing model-free control, which is pretty popular and relevant these days, and then you actually look at what your control algorithm should be, right? These two stages. So let's start here. Let's start by talking about a model for the price of an asset or returns on assets. But before we do that, let's look at a model for just interest rate. And this is something that we're all very familiar with. It's an example that you get in high school, probably first year in college. But so we're talking about the model. Let's see. So we want to talk about some risk-free asset. Sorry, I need to get back in the hang of this thing and just look at the screen. Okay. Talk about some risk-free asset. ST, which is just going to follow simple model. Given here, so this is of course exponential growth if R is positive. And this yields, the solution that we're very familiar with, which is if we have some initial price, S0, or some initial value, some initial investment S0, and we'll say that's just lowercase s, then we're going to have that ST is equal to S. I already made a mistake. Right? No. Right. So this is the exponential growth, right? The rate of growth of our the value of our investment, S, is going to be proportional to the current investment S, and so what we get is, of course, exponential growth. So this is what we would call a risk-free asset. we know deterministically what the value of this asset is going to be at a future time t. Okay, so obviously well, let's say like what might be a real life example of this. If we keep our money in a bank, right? Also bonds. So those could be bonds issued by a company or bonds issued by, well, there's a little bit of risk, there's risk associated with that, but bonds issued by the government, for instance, T-bills, those are going to be steady interest rate. Now let's talk about what a risky asset might look like. So the risky asset, I'm going to call R for risk. And here, a very common model, and of course, what we're trying to do here when we're talking about returns on risky asset is we're trying to create a probabilistic model because we're not sure what the return is going to be into the future, and that is a very fraught exercise, right? Because in the future this thing will be realized, there will be some actual value, and we don't really know what that's going to be, and there's a lot of things that can happen. There could be shocks. I mean, look at like 2008, look at 1999, look at any of these dates, and there are huge shocks. There are real fraught issues with trying to come up with a model for a risky asset. But nevertheless, economists and financial engineers persist, and they like to use kind of an introductory model. This is kind of like the most basic model that people use, which is geometric Brownian motion. So this first term looks identical to what we had before. So we kind of anticipate that this is going to be something like exponential growth. But we have a stochastic term, turning this into a diffusion process. That is the differential of Brownian motion times our current value of our risky asset. And these constants that we have here are things that we want to estimate in order to fit our model to like an actual, like an example here, this is like a stock, right? Maybe an option could fit into this model. I think when you start talking about financial derivatives, maybe this is not exactly the model that you want to use. I think that might be a place where you might use Black-Scholes to talk about the value of that financial derivative, but certainly sorry, that's meant to say option, but certainly a stock. We would hope to model like something like a stock with this geometric Brownian motion. And these constants, these coefficients have names. Economists call this, diffusion coefficient. They call it volatility. And then this mu, before this R is what we would call this the rate of return. This is the expected rate of return. Okay, expected rate of return. And in real life, in this model, we're treating sigma and mu as being fixed constants, but in real life, of course, volatility changes over time. For instance, there is actually an index that tracks the volatility of the S&P 500. Well, it's just called this over here, the VIX. That's a volatility index. It's one of the indices that tracks the volatility of the S&P 500, and you can look at that, and it's certainly not constantly timed. It varies a lot, and again, I have to put disclaimers around everything here. Everything here. this is all we're modeling. It's a fraud exercise, but people have serious issues with the VIX. It uses kind of like a running average of like the last 30 days to estimate the volatility of the S&P 500. And that is not forward-looking, obviously, and you can't be forward-looking. That's the whole problem. But yeah, there, economists say that like you should be wary of trying to use the volatility index in your modeling or in your algorithms. But yeah, so we call these terms the expected rate of return and volatility. And this thing here is what we call geometric Brownian motion. And that's going to be our model for a risky asset. And you can see that, in the case that sigma goes to zero, we just return to the risk-free, the model for the risk-free asset. So some things to maybe say about geometric Brownian motion is that the distribution for processes given by this differential equation is going to be the same as the distribution of the exponential of a Brownian motion. Which one thing that implies right away is that, okay, well, this thing has a log normal distribution, and what that also implies is that our RT is going to be almost surely greater than zero. So that's a nice thing about this. One nice feature of this model is that it's positive value, which we would hope when we're talking about the value of a stock, right? The worst you can do is to have that stock go to zero. Well, you can do worse if you're investing, but in terms of the stock itself, the worst it can do is go to zero. So that's a nice pro of this model. It's also rough, in the way that Brownian motion is and nowhere differentiable, which is pretty similar to what we see in real life. The expected returns are going to be independent of the current value of RT, which is also fairly realistic. It's also relatively easy to compute with. Sometimes when we're choosing models, I mean, why do people like to use normal distributions to approximate everything? That's another disclaimer, right? Some people say, like, if you've read like Nassim Nicholas Taleb, he talks a lot about the issues of using Gaussian distributions to describe real life stochasticity, because you have these tail events, these black swans, and this is all fundamentally based on Brownian motion, and that has problems as well. We like it in part because it's relatively easy to compute with. But in terms of negatives, like I said, volatility is actually going to change over time. And in real life, you also have jumps rather frequently. So I can kind of illustrate that here. This is post-election this year, just a couple months ago. It's kind of cheating here, this jump right here, because this is representative of overnight trading. This is the end of the day here, and then that's the beginning of the day. But you have this high jump post election, but then also kind of interest, I guess, is that you have this return back to what it was on track to be prior to the election as well. It's reversion to the mean, I guess, of the S&P 500. But that's just to say, yeah. So real life, you also you have jumps. So we'll talk a little bit more about much later about modifications you can make to this model to try to include jumps as well. Okay, so these are the models we're going to be talking about today, and in particular, we're just going to look at the case where we have one risk-free investment at our disposal and one risky investment at our disposal, and we can combine both of these processes into a single wealth process. So we're going to talk about wealth process, which I'm going to denote by XT, which is going to be some fraction pi t times our risky asset. So this pi t is going to be the amount that we have invested in the risky asset, plus 1 minus pi t times our risk-free asset, ST. And of course, pi t is going to be in the interval 0 to 1. Okay. And so given what we have here, we can write down our process for our wealth, right? I'll write that this is our wealth. I'm not writing initial conditions yet. Of course, typical initial conditions, x0 is equal to some lowercase x. We can write a wealth process just by multiplying this above equation by 1 minus pi t, this lower equation by pi t, and adding together what we get. So that will give us the wealth process r plus mu minus r. Yeah, so I think I've already said this before, but just to be clear, r is our fixed rate of return on our risk-free asset, and mu is the expected rate of return on our risky asset. And so for any of this to really make sense, we're probably going to want to have mu greater than r. I mean, certainly mu can be less than r, but if you have any sort of aversion to risk, you're just going to put your money in that case in the risk-free asset as opposed to the risky asset. So it's not really a problem at that point to be solved. And then we're going to have this term multiplied by our the fraction invested in the risky asset, pi t. That is going to, and I'm going to, because we're going to be solving for this pi, I'm just going to include the superscript pi. And then that's going to be multiplied by the current value of our wealth. Plus our volatility term. So we only have volatility coming from our risky asset. But yes, this is going to be our wealth process. So this is the model that we're going to attempt to control in our stochastic optimal control problem. So that's our model. Now let's talk about what the problem is going to be. So the problem is that of portfolio optimization. And the person who formulated the portfolio optimization through the language of stochastic optimal control initially, as far as I know, is Robert Merton, Nobel laureate in economics, in part, well, got the Nobel Prize for the Black-Scholes-Merton PDE, which, is all about pricing financial derivatives. As far as I know, he was the first person. There's earlier work on portfolio optimization, but it's as far as I know, it's kind of like a static problem, and that's modern portfolio theory. And I think the name there is Markowitz.
Markowitz. Yeah.
Markowitz.
Markowitz.
Oh, nice. Okay. Yeah, Markowitz. But this is putting it. This is the approach here is about what we call, not me, but I guess economists call expected utility. So our optimization problem that we're trying to solve is we're trying to find the supremum over choices of pi t, bounded by the fact that pi t is a fraction between 0 and 1. We have to deal with that constraint. So it's not over all the real numbers, just over this interval. And the way that Merton wrote it down, kind of the general form for this is you have a utility function for your wealth. And we're going to talk a bit more about utility function, what they look like, and why you use it. Sorry. Yeah, I just wrote this incorrectly here. Okay. And then we might have some sort of running cost or running value. We're looking at things in terms of value in this case. You might have some running value as well, some utility function that's time dependent, and a consumption function that's dependent on your wealth. I don't know too much about this in the full generality. And today we're not going to be looking at a problem that includes this running utility function, and instead we're just going to focus on this terminal utility function. So the goal is going to be to maximize the expected utility on our final wealth at some defined future capital T. So this, in combination with our wealth process, which gives us our dynamics and our initial condition, our initial wealth, defines our optimal control problem. And yeah.
So I'll step behind. I'm confused about your wealth process equation, the last term,
Okay.
because you're telling me that it should be RT in the last.
Oh, well, there shouldn't be an R in the last term because
Somehow I have to get rid of it, but then the RT satisfies the same equation we had before, right?
oh, you're saying R, you're saying big RT. Yeah. Did I write down?
You wrote both equations less than T, and you just use them in this linear combination, correct?
Oh, yeah. So what has happened is did I make a mistake?
You add both equations weighted by pi t and 1 minus pi t, so the RT should be.
Right. So is the pi t that shouldn't be there? Or
No, I think both should be.
okay, let's work through the derivation just to sanity check. Okay. So of course we're gonna say that our differential dxt is going to equal pi t drt plus 1 minus pi t dst. And that differential is just coming from the way that we defined our wealth process here. Then our dxt, we're gonna plug in our expressions for drt and dst. So for drt, we're gonna have mu and okay, I guess I need to write down a few more expressions, right? I might have been mistaken. We'll see. We'll see. Okay.
I think this wealth process equation becomes correct once you put RT there in the last term instead of XT. But you're right, you want to write equation for just XT.
Right. Okay. Let's see if let's see what happens if I just keep things in terms of RT and ST at first, and yeah, we'll see what happens as a result of that. Okay, so we'll have mu RT plus, or sorry, dt plus sigma RT dBt plus 1 minus pi t, and then here we're just going to have r st dt. Okay, so okay, so we're going to want to make a substitution that we have here. So yeah, kind of that is kind of tricky. Okay, I'm gonna have to go back and check this model. I know that it's going to get us to the right solution. At any rate, I mean, let's just say that this is the model that we're using. I'm gonna have to go back and check that and maybe send an email out later. but yeah, let's just go forward with this model, but thanks for bringing that up, Sergey. Just because I don't want to, yeah, sidetrack the talk too much. Okay. So, all right, so at any rate, we do have, you know, whether or not it's the right optimal control problem, we do have an optimal control problem defined. We have our stochastic process that we're trying to control. We have our value function defined. And then, yeah, some initial conditions. Okay, so, you know, taking back, a month or two ago, back when we talked about stochastic optimal control and continuous time and continuous state space. And we defined a very useful operator that, you know, led us to the Hamilton-Jacobi-Bellman equation, which we call the infinitesimal generator. And in general, maybe I won't write it in, I should write it in full generality. Okay, so yeah, if we have some process dyt, just one-dimensional process with some function f yt t times our time differential plus some g yt t times our differential for Brownian motion. Then our infinitesimal generator in this case, because you know, Brownian motion is rough and we have to consider the second derivative when we're Taylor expanding this process, we find that we have this operator, which the value of this operator is it gives us a forecast of what our expectation is going to be in some infinitesimal time step. So for this process y, this operator is going to be partial t, and some people don't define infinitesimal generator with this partial t and, you know, leave the partial t out. But at least what I found in Merton's paper is that he did include this partial t, and that's my preference, so that's what I'm going to use. And we have plus our f. And because I'm using y here for our state variable, it's going to be partial y plus 1/2 g y t, this quantity squared. Second partial with respect to y. This is our infinitesimal generator, and we can we're going to want to evaluate this for our model that we're using in order to derive the Hamilton-Jacobi-Bellman equation. So this is just kind of the general case, and then if we were talking specifically about our wealth process, we're going to have partial t. In our case, our f is going to be this expression up here. So we're going to have r plus mu minus r pi x partial x plus 1/2. We're going to have sigma pi x, this quantity squared, and then the second differential with respect to x. So this is our infinitesimal generator, and it's going to be it's useful because it, like I said, it forecasts what the expectation of some function is going to be under this stochastic process that we have. So yeah, we use this we can apply this to some function. Here we're going to talk about some function h. Yeah, we can apply this to h, and it will tell us how h is going to change one infinitesimal step into the future. Okay, so with the infinitesimal generator, and due to the fact that we don't have this running cost, our Hamilton-Jacobi-Bellman equation is just going to be this infinitesimal generator applied to our optimal value function, the cost to go, I guess, would be the value to go in this case, or you could call it the Hamiltonian. But previously we called this function v, we might have called it j as well, but today we're gonna call it h. And yeah, this actually what I wrote here, I can just say that this thing is equal to 0. And I'm going to have to take the supremum as well, so maybe I'll just write it out again. We're gonna have partial t plus Rx partial x. So this is the part that is independent of our choice of control, pi, right? That's the control variable that we have, is pi in this case. Apply to a function h, and then we're gonna have to take the supremum in this case, because we're trying to maximize our value. A supremum over our possible range of pi, which is that interval 0 to 1. And yeah, so the remaining terms that we have are this mu minus r pi t x partial x plus 1/2 sigma it x squared, that whole quantity squared, partial x, and I should include my h in here as well. Okay, equal to 0. Right, this is the HJB equation. Or you can call it the dynamic programming equation. And then of course we have to include our terminal our terminal data as well, our terminal condition, which is going to be that h x t at our final time capital T is going to be equal to our utility function, which is some unspecified function u of for right now. Yes, so this is our Hamilton-Jacobi Bellman equation for our stochastic process. And yeah, if we had that running cost, we would have some cost term as well. But we're just looking at a sorry, I just keep on saying cost, but yeah, terminal or running value. But in this case, we're just looking at a terminal value. Okay, so you know, the process with solving these stochastic optimization problems, with solving the HGB, is the first thing that we want to do is find that pi t that is going to yield the supremum, or maybe realize the maximum for this term that we have here. So if we want to maximize with respect to pi, we can note that this term that we have here, as it's been in previous cases, this is a quadratic in pi. So just writing out that quadratic, we have 1/2 x squared partial xxh times a pi t plus mu minus r x partial xh. This is our quadratic that we aim to maximize. But let's talk about what we would actually need in order to be able to maximize this quadratic. I mean, we're going to be able to we're always going to be able to achieve the maximum, because this is some bounded quadratic, right? Pi t is just living on some interval 0 to 1, right? And so it's just a question of, is this maximum, is it going to be inside of our interval? Is it going to be at the endpoint of our interval? You know, maybe this quadratic is you know, actually concave up. These are questions that we have to answer if we're gonna try to maximize this quantity. So it kind of all rides on this, the value of this second derivative of h. And why is that? Well, this is, everything else here is positive in terms of that leading coefficient. So it's really just a question of, is partial the second partial with respect to x of h, is it positive or is it negative? So this is kind of getting back to the question of this utility function that we have here. Okay, so what the utility function is trying to do is it's trying to say how much do we value some amount of wealth x, and you might intuitively say, well, maybe maybe this utility function is just linear or affine in x, or linear in x, right? Maybe u of x is just some just proportional to x. But that's going to actually break our equation, and it's also not it's not what people typically do. It's not what people typically, it doesn't represent the preference that people typically have. So saying something like this, that our utility function is just proportional to x, would say something like earning $100 is equivalent to losing $100. And that might sound good at first, but what if you only have $100 to your name, right? Well, equivalent in the sense that, okay, obviously one is good and one is bad, but it's saying that these things are, just up, they're the same up to a change in sign. It would also be saying something like, if I'm a millionaire and I get $100, it's the same thing as, having $0 and getting $100. This intuitively, this is incorrect, right? Those $100 are more valuable when you have only $0 as opposed to when you already have $1 million, right? And what this is kind of begging is, instead of having a utility function that is linear or increasing in x, our utility function is well, it should be increasing in x, of course, right? What's really this is saying is it's talking about the second derivative of our utility function. Whether this utility function is concave or convex, what this whole line of argumentation is saying is that this second derivative of u should be less than 0. So like, a kind of a sensible choice of u might be something like, well, I've got some examples, but something like a logarithm, for instance, right? This thing is increasing monotonically in x as it should be, right? If you having more wealth is for most people is going to be more valuable than having less wealth. So you want this thing to be monotonically increasing. But it also captures this fact that we want our second derivative to be less than 0. And another nice thing is that it puts kind of this infinite negative utility on having exactly $0. So this is, a log might be a good choice of u. Another good choice of u could be an exponential, not just a straight up exponential, but something where we have like negative exponential of some the negative of exponential where we have this argument that's negative gamma of x, gamma being greater than 0, where we're going to have some finite utility for having $0, but some different profile for the utility. There are other choices as well, but yeah, what we're going to see is very viscerally in this problem that we have. If we don't have a concave utility function, it's going to break it's going to break things.
Probably force it to take maximum risk.
Yeah, okay, and that's really that's the whole idea here, is this utility function really captures the idea of risk aversion. If we had a utility function with a second derivative equal to 0, that means we're just trying to maximize the expectation of our wealth. So if we have a risky asset that has a higher expected rate of interest, we're just gonna put it all in the risky asset. It's not a problem anymore.
Which is what young people often do.
Right, exactly, right, yeah, yes. So really what this utility function is doing is it's a way for economists to build in some risk aversion into their into their models. So that's the utility of the utility function is to build in some risk aversion. And we'll talk a little bit more about that if we have time later. But also that's relevant here because we're going to we're talking about the second derivative of the utility function, which is obviously linked to the second derivative of the Hamiltonian as well. But basically, I mean, what we have here is we have three cases, right? We're either going to have a maximum at the endpoint, so either our pi star is going to equal 1. Let's say this. It's either going to be 1. It's going to be 0, right? So 1 would mean we're throwing everything into the risky asset. 0 means we're putting everything into the risk-free asset, or we're going to put it in some amount into the risky asset, some amount into the risk-free asset, which is obviously the more interesting case. And that's going to be the case when we have a concave parabola and the vertex lies somewhere within our interval 0 to 1. So the conditions for that, just first order conditions, we're going to have that in that case, pi t will be equal to so I'm going to write out something. I'm going to have to explain the term here. So this is the term I have to explain. I have to explain what lambda is. Sigma x partial x h over second partial of h. Okay, it's gonna be one of these three things, and and of course I need to say what the criteria is for getting one of these three things. But this lambda, what is lambda? It's an important value for financial engineers, referred to as the Sharpe ratio. So it's going to be mu minus r over sigma. So that's the expected rate of return over our risk-free investment divided by the volatility of our risky investment. So financial engineers like this metric for the quality of the portfolio because it is adjusted for risk, right? You don't want given the choice between two investment portfolios that have identical expected rate of return, instinctively we want to choose the one that has less risk associated with it, and this Sharpe ratio does exactly that. As long as mu minus r is a positive value, then this Sharpe ratio will favor a portfolio that has a lower volatility associated with it, right? We want to have a higher Sharpe ratio. Yeah. And this is really like the metric that it's one of like the very standard metrics people use for evaluating an investment strategy.
It measures whether you won because you're clever or because you're lucky.
That's really well said. Yeah, exactly. Okay, so yeah, so that's just throwing a little brief finance lesson in here by just defining this variable for us. But yeah, I mean the cases for choosing any one of these, I mean it really just comes down to whether this thing is between 0 and 1, right? This is negative out here. This is going to be in general, based on what we have here, this should be a positive value. This should be positive. X is going to be positive because it's our wealth. And then this thing is going to be negative if we have a sensible utility function. And then partial x h will be positive because of the fact that u should be monotonically increasing. So this thing will in general will be positive, and then which policy that we choose here is just a question of whether this quantity here falls within the interval 0 to 1. Okay. How are we doing on time? I feel like I've eaten up a lot of
10
time.
to 15 minutes.
Okay, wow, okay, well, yeah, right, start a little bit late. Okay, okay. Well, let's see if we can solve this, right? It's a little bit tricky because we have multiple cases with our control variable, and honestly, I have not solved one of the cases yet. But so long as pi is actually between 0 and 1, I do have a solution. But first thing we should do is just see what happens when we plug in this particular control policy into our Hamilton-Jacobi-Bellman equation. Okay, so what we're gonna have, and I'm not gonna go through the manipulations, so I'm just gonna write down what I have. We have this component that's independent of our actually, I'm gonna write it like this. We have a component that's independent of our control policy. And then what we're gonna have from plugging in this particular form of pi star is going to be what I think is a really perplexing PDE, nonlinear PDE that I've been puzzling over. Oh, partialized. Right. So this is the HJB with that control policy, this particular control policy plugged into it. See. Right, and then subject to our terminal condition. And I've thought about whether there is a general solution to this PDE, and I have not come up with anything yet. If anyone has any methods of like how to determine whether or not this has an analytical solution, be very interested. But I think it's quite nasty. It has, I mean, you know, we have this this derivative of the function in the denominator. We have the like quotient nonlinearity, which, you know, I haven't seen too much, but I haven't seen too many equations. But yeah, this would be the Hamilton-Jacobi-Bellman for that particular control policy. So because I don't have a general, sorry, this should be ooh. Okay. This should be UX, right? Because we don't have a general solution, we'll look at some particular forms of the utility function.
Do you mean h of x is 0 is x?
Oh, sorry. Well, this should be the terminal time.
Term.
Yeah. Yeah. Great. And then also just to write it out, let's look at these all-in control policies as well, because if we're trying to find the full solution to this, we would also need to consider these other PDs where we're all in on the risk-free or the risky asset. So these are also just I mean, of course, because we're all in on a single investment, these are just the equations for expected value of just holding one particular asset. So we're gonna have partial t plus rx partial x h equals 0. This is the case that this should be the case that pi equals 0, right? So we have no investment in the risky asset. And then the other case, pi t equals 1. And there we have our infinitesimal generator for the risky asset. So relatively nice equations here, obviously linear, non-homogeneous, well, I mean, non-homogeneous in the coefficients here. And I mean, we can write down a general solution, well, I've written down the general solution for this one. The other one, I didn't have time to write down the general solution. But, yeah, given some utility function, ux, then our, Hamiltonian is going to be equal to u, and I believe it's, it is, yes, xe, it's a negative RT. Right. So yeah, so given some utility function, we have right away, some solution to this transport equation.
T minus capital T or something, because of.
Oh, yeah. Yes, of course, you're right on that. Yeah. Good catch. Okay. Yeah, this should be, I believe, like this. Nope. T minus. I believe that's right. Yeah, that should satisfy the equation. This is not negative. I don't know if I can erase with that level of detail. Okay. Here, I mean, what we're really doing here, I mean, what you can think of is we're finding a Green's function for a transport equation, and the Green's function is going to look something like a Dirac delta, and then we're taking the integral with that Dirac delta to produce this translation of well, it's not strictly a translation, but some warping, I guess, of u in order to get the Hamiltonian. And in this other case, because we have this diffusion term, we can again use a Green's function, but we're going to have something that looks like a heat kernel involved in it. And I think actually, so what I want to do at this point, we have the Hamilton-Jacobi development for the case where we have this non-trivial control policy. We have the Hamilton-Jacobi, well, we have these other equations for the value function for these all-in control policies. And because we have this like highly nonlinear Hamilton-Jacobi development, I would like to look at two cases where we can actually solve this thing exactly. And they happen to be the two utility functions that we looked at earlier. So we looked at the log utility and the exponential utility, right? So in the case of the log potential, let's see, how do I want to use the rest of this time? I'm going to write down the equation that I got, or the equation for this for the Hamiltonian in the case of the two utility functions, and we could check it, but I'll just go ahead and write them down. So in the case of log utility, and I should number these equations so we're not going totally insane. Let's call this 1, 2, 3. Okay. If we're looking at 1 with log utility, so ux is equal to log of x, then I believe we will get a Hamiltonian of the form log x plus r plus 1/2 of that Sharp ratio squared times t minus little t. So it's just in this case, it's just the utility function log x plus this this linear component in the time t. So our value actually increases as we go further back in time. That's because we expect to get returns on whatever initial wealth that we have. So it's more valuable to be at a particular value of x earlier in time than it is to be at a particular value of x later in time. And that's what this term here captures for us. In this particular case, our control policy is very simple. And so this is actually a case where I believe the Markovitz,
Yeah.
the Markovitz portfolio theory matches the expected utility theory, because we get that our investment strategy should be some constant, independent of time, independent of our value of wealth, some constant that is not pi, sigma. That is a ratio of the Sharpe ratio to the volatility, sigma. So some fixed fraction we invest in the risky asset, and the complement of that we invest in the risk-free asset. Regardless of what the market actually does, we hold this position.
This is still case one with low utility. This is still case one with low utility.
Yes, yeah, it's case one. It's the nonlinear Hamilton-Jacobi-Bellman equation with long utility. I mean, it's kind of satisfying working through this proof, but we do not have time today. So in the case where our ux is instead this exponential utility, where we have some parameter gamma, and this parameter gamma controls the level of risk aversion that we have, right? Smaller gamma, closer is to zero, that the closer this thing approaches to a line, and that represents being totally not risk averse. Higher gamma, higher risk aversion. And actually, maybe this is a good point to mention this, just because comes to the end of this talk. There is a term called absolute risk aversion, ARA, which is defined as the negative of the second derivative of our utility function over the derivative of our utility function. And this is really like this kind of captures what our level of risk aversion is. That's the absolute risk aversion, and then the second quantity is the relative risk aversion, which is exactly the same, modulo this term x. So it's relative to our current wealth x. And that's useful for looking at these two control policies, because what we would find is in the case, if we look at the absolute risk aversion of our log x utility function, or rather, if we look at the relative risk aversion of our log x utility function, we find that this thing has constant relative risk aversion. And in the case of the exponential, this thing has constant absolute risk aversion, which I haven't fully thought about, but should go some way to explain the sort of control policies that we have. The fact that this is a constant control policy is a reflection of the fact that we have well, in this case, a unit relative risk aversion. And then what we find is, in the case of this exponential utility function, that our Hamiltonian did not give myself enough room for this. Let's write a little bit lower. Should be equal to, I might be missing a sign here. I'm not sure about the sign up front. But we have negative gamma x e to the negative, or should be not negative, RT minus c minus our Sharpe ratio over 2 times our volatility, t minus t. So we have the exponential of an exponential. And in this case, our control policy, assuming that our control policy does fall within this interval 0 to 1, is lambda over gamma, which is, that measure of risk volatility, so in this case, or rather risk aversion. In this case, our absolute risk aversion for the exponential case, our ARA is equal to gamma. Times e to the, okay, I believe, again, I'm not quite sure on the sign here, I kind of psyched myself out. But I believe this should be our control policy. It should be increasing as t gets closer, as little t gets closer to capital T. Should be increasing, so I think this might be negative. Is that right? Okay. This might be negative too, sorry. Okay, well, we're almost done with time. But what we have is we have a different control policy in this case. It's not constant in time. And instead we have this, that it's exponential in time. Okay, I'm gonna have to go back and check some results on this, but I do have some kind of some simulation results. So these are the case where we have the two utility functions, exact same underlying dynamics, obviously different realizations of the dynamics, but the exact same model in both cases. And we have the log utility function on the left and the exponential utility function on the right. Picture in red would be our expected returns on the risky investment. And then in the blue, the returns on the risk-free investment. And then in the bottom, we have the proportion of our portfolio going into either the risky or the risk-free investment. So in the log case, we see that we have a constant allotment into both the risky and the risk-free investment, and then we have the increasing riskiness in the case of the exponential. And basically, I think the intuition there is that as you get closer to the ending time capital T, there's a bound on how bad the market movements can actually be and how much they can sabotage the wealth that you've earned up to that point. So you're able to take a riskier position at those later times. But yeah, I mean, the attendance I think is a little bit low at this case. I did want to kind of have like a discussion of like maybe how machine learning and reinforcement learning could fit into the sort of application. And there are ways to generalize this model. I mean, we could talk about jump diffusion processes. So that's the case where we're going to add a Poisson process to our diffusion process. So Poisson process is a counting process. At any instance in time t, there is some rate function in general, lambda, that controls the the probability of actually making a discontinuous jump inside of that interval. The kind of vanilla Poisson process is only looking at increasing these jumps being increments of 1 upwards, but you can in economics it doesn't really make much sense, so you can generalize this to talk about some distribution over the size of these jumps, and that's what you call a compound Poisson process. So that's another way, and you can define an infinitesimal generator for the jump diffusion process as well. It's a little bit more interesting because it's not, the underlying process isn't continuous, but you can still define this this operator for it. Yeah, but I mean that's all I have for today. So hopefully, I mean there's a lot of material, and I'm still relatively new to this field, but maybe you kind of got a little insight into how people use stochastic control in the field of financial engineering.
Thanks, Andrew.
Yeah, thank you.
Last question.
Yeah, any questions online? I'm not sure. There's still people. Yes, there are. If there's any questions online or in the room, or like, I don't know. I mean, like this paper, the paper that I'm kind of working off of is like from 1971. This is old, but I think it's an interesting application of stochastic control. Thank you for listening.
What's the color scheme? What does blue and?
Yeah, the color scheme in the top figures is gonna be the value function, yeah, so it's gonna be the Hamiltonian, the value function. Evaluated at that, state X and that, time T.
So on the left, practically doesn't change.
Yeah, I think in that case, so there should be a term that is linear in T, I believe.
So the correcting log with in
Yeah, so the expected value, the Hamiltonian, should increase going to the left linearly. It increase as you go further back in time linearly, because like what I said earlier, like, these things are growing. And it's more valuable to be at a particular value of X earlier in time than this later in time. But I think it's just kind of being dominated by the logarithm term here, which is why you have that really sharp gradient at the bottom, is because, that's going to negative infinity. There's a little bit more noticeable variance with respect to time in the case of the exponential utility function. Yeah, did I have something else to say about this? I don't remember it. If I did. Yeah, in this case, you can see that our optimal control is falling within this interval 0 to 1. So this is a case where we don't have to worry about those other HJB equations that we derived for the case of the optimal control either being all risky or all risk free.
I'll comment, if people want additional references on risk sensitive stochastic optimal control, there's a fairly extensive literature, it goes back to the 70s also. The name to look up is Peter Whittle, W-H-I-T-T-L-E. And then Bert Kaplan, whose papers we reviewed earlier, has written a lot on this subject. And actually Nisha Cherkov is with Bert Kaplan right now in the Netherlands.
Oh, cool. Nice.
So, yeah. And I think there's a pretty natural use for reinforcement learning here, because as you mentioned, a lot of the work is actually got into discrete time, a lot of the canonical portfolio optimization stuff, so there are.
Yeah, actually, I had a question regarding that. So my research is right now regarding risk sensitive reinforcement learning. And a lot of the things that are being done nowadays has to do with coherent risk measures, which essentially came directly from the finance literature. And the question that I had is, every once in a while that I'm just digging through papers, I ended up hitting one of those finance papers. So I was just curious, what is like a good source to start with? Like, I don't want to go too deep into it, but just like, I think you had like, was it a book or was it a paper, the first thing that you
Yeah,
had?
I did include a book here, and it's been a pretty good reference, but like honestly, this is the only finance reference that I've actually, like, I just started being interested in this stuff like this semester, and it's not my main research. So,
Yeah.
but this is the textbook that I found. Like I modified the problem. They presented this problem. Like it's obviously it's the Merton problem, but it's kind of like a stripped down version of it, where you're only looking at two assets, one risk free, one risky. Yeah, there's some other simplifications, like you don't have that running consumption value. But there at least in this section, there were some issues that I had with their presentation. Like they kind of present the risk-free process as being like this, it almost looks like it's supposed to be an independent process from the wealth process, which doesn't make any sense. So like there's some minor quibbles I have with the book, but it's been a decent reference, and the book starts with just talking about some empirical facts of the market, which if you don't know anything about how the market works, it's interesting and useful. Like, like when you buy a stock, like how does that actually work, right? There's got to be somebody who sells you that stock. It's this like idea of like market orders, limit orders. If you put in a market order, then there's somebody else with a limit order, somebody who's willing to sell the stock at that price. And then there's this concept of like walking the book, like you're trying to find somebody who's gonna sell you that asset, and they might not sell it to you at the price that you actually want to buy it at. Or maybe if you're working like very high volumes, you could buy up all the things at the price that you want and have to go up to the next price. And concepts of like liquidity and all that stuff. I mean, they cover it fairly well. I wish I had a better reference, and if you find one, I'd be happy to know about it.
Okay.
Is there something else in the chat, or is that just the, thank you, okay. Yeah,
Yeah, Alonso, a lot of, I actually started to look at this for research a couple of years ago, and someone recommended this book by Stephen Shreve called
Okay.
Stochastic Calculus for Finance, and I think it's 2 volumes.
Stochastic what?
Stochastic Calculus for Finance. There are 2 volumes.
oh, I would say, like, also, if you're just talking about stochastic, like, if you're interested in the stochastic calculus aspects of these things, like, the, you know, one of the people who wrote, like, you know, really great textbooks on, stochastic calculus is, Bert Parsons,
Yeah.
and he worked a lot in finance as well, so if you want like a nice, like, mathematical treatment of this subject, then Bert Parsons, yeah, a good reference, but that's gonna be more on the mathematics rather than, I guess it depends on if you're interested more in like the nuts and bolts of how the market works versus like the mathematics of it.
Mhm.
Maybe he'd be a great mathematical reference if you want like really rigorous treatment. But if you're more interested in just like how does the market work, then yeah, then I don't know, maybe the reference that I have here, the card data, would be a good one. But yeah. Cool, adjourned.
Sure.
Okay.
So that's,
Thank you for attending.
Any further talk?
Thanks. And actually, considering this is finals coming, this was actually a decent turnout, I think.
Okay.
So everyone have a happy holiday, and we will reconvene in the spring.
That's good.
Thank you.
Think of this, please.
Okay, great, thanks, Sergey.